Thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is Tullow Oil, who released their full year results on the 9th of March. We're really pleased to have with us today Rob Hellwig, the Group Treasurer and Head of Investor Relations. And I now would like to hand over to Rob to start today's presentation.
Alex said, my name is Rob Hellwig. I've been with Tallow for over 15 years now in a variety of functions, and I'm currently the Corporate Treasurer and the Head of Investor Relations here at Tallow. So if I flick forwards to the first slide number 3 here, and I hope you can all see that. I'm sure Alex will tell me if you can't. Let's just start with an update on our progress since late 2020. You may recall in November 2020, we had set out a new strategy and a 10-year business plan for Tallow aimed at turning around the business and creating meaningful value. And last year, 2021, we have started to implement that plan. The first task that we faced was the refinancing of our near-term debt maturities, where just over less than a year ago, we were in refinancing talks with banks and bondholders, and we managed to successfully refinance our debt with longer-term maturities. And we were able to do that because of a substantial amount of self-help, as we call it, in the form of cost reductions, both operating costs and overheads. We also executed a number of asset sales, and the strong operational performance also helped us, and of course, improving market conditions at the time. We now have, as a result, a capital structure that provides us with financial headroom and time to invest in some of the high return opportunities that we have in our portfolio. Implementation and delivery of that business plan progressed very well in 2021. We delivered very strong operational performance, and that translates into uptime on our FPSOs, gas offtake rates in Ghana, and water injection rates also in Ghana. We have also successfully drilled and completed 4 wells in Ghana and completed a well workover. And in respect of Jubilee, that allowed us to achieve very notable production growth. We started 2021 with about 70,000 barrels a day gross, and we ended the year at about 90,000 barrels a day. So that's a 20,000 barrel a day increase from the start of that drilling campaign in April. As we look forward, we have a deep portfolio of very high return investment opportunities across all our assets. And in 2022, we will be investing in all of these to deliver growth. In addition to investment in our existing producing assets, we also have a number of catalysts that we believe could drive value. For example, the preemption of Occidental Petroleum's asset sale to Cosmos in Ghana, which we preempted, and that preemption was completed a couple of weeks ago. That's a very value accretive transaction for us, and it really underscores our confidence in the potential of these Ghanaian assets, and it will have a very material impact on our production and cash flows. It's just worth noting as we run through these slides, any figures in respect of Ghana and group that you'll see do not reflect the impact of the preemption. That's because we haven't really updated to the wider public any slides with those numbers in them. But I can give you in the voiceover an indication of the impact where that is relevant and appropriate. For example, on this slide, you can see compound annual growth rate production from 21 to 25 of about 6%. The additional equities from the preemption in Ghana will actually increase that to about 8% over the same period. Also in Ghana, the successful delivery of the Jubilee O&M transformation, and I'll talk about that a little bit later, that is taking on the operatorship of the FPSO, we believe will enable us to sustain the very, very good operating performance and drive further cost optimization. And one of the catalysts also in Ghana is the commercialization of our gas resources, which is not just important for us in terms of value, but is also important for the economic development in Ghana. We have a reworked development plan in Kenya that will deliver more value for Kenya itself and has improved economics at low oil prices and is therefore more investable. And in South America, in Guyana, we have an exciting exploration well coming up this year. So while the whole industry is in somewhat of a flux as companies try to figure out how to play the energy transition, our view is very, very clear. As long as there is global demand for hydrocarbons, Africa's oil and gas assets need to be developed and produced responsibly, efficiently, and transparently to deliver economic and social benefits to the countries. We as Tallow have a long and proud history in Africa, and we're uniquely positioned to help the countries in which we operate. We have a target to achieve net zero by 2030, and we have an emphasis on responsible operations. We will ensure that the oil and gas resources of our host countries are developed efficiently and safely while minimizing the impact on the environment. Through our work, we'll deliver shared prosperity and will create value for our investors, our staff, and our host nations and communities. We believe that the new Tallow is well positioned for the challenges and opportunities that our industry brings. As you can see from the achievements that we're stating on this next slide, 2021 was a truly transformational year for Tallow. First, we successfully completed a comprehensive debt refinancing, which leaves us with material liquidity headroom and no near-term debt maturities. Again, this was underpinned by self-help from asset sales and a significant reduction in our cost base. We have embedded a performance culture where, and you've heard Rahul say that probably many times, every barrel matters and every dollar counts. And this will ensure that the reduction in our cost base is not just a one-off, but is sustained and will not be reversed in the current high oil price environment, which is something that across the industry we have seen time and again. With leverage approaching 2 times at the end of last year and substantial liquidity headroom, we are now well placed to further strengthen our balance sheet while investing in our assets to deliver value. We believe that we have a very disciplined capital allocation framework, and we will continue to prioritize deleveraging. We plan to reduce our gearing to less than 1.5 times, which we consider a sustainable level in the context of our industry and an investment program. We have a deep inventory of investment opportunities, which is focused on producing assets, which all have high returns and very short paybacks. As an example, the investment in 2021 in Ghana, in terms of the drilling campaign, they have already paid back within 12 months. And we think that our 2022 investments in Ghana will pay back in less than 2 years at an assumed $75 a barrel oil price average. Our investment activity is self-funded from our strong operating cash flow, and that gives us a certain amount of flexibility to respond to the external oil price environment, flexing capital up or down as oil prices move. We are open to inorganic opportunities, but we will certainly ensure that they are value accretive and demonstrably deleveraging. One good example of that is the Occidental Cosmos transaction in Ghana, which certainly meets both of those criteria. Commodity hedging remains a very important tool in our financial risk management strategy. As part of the refinancing last year, we committed to implement a very significant hedge program to protect against any oil price downside. And that saw us protecting 75% of forecast production entitlements for 2 years from the refinancing through to May 2023, and then a further 50% protection for the following 12 months through to May 2024. I would, however, like to highlight 2 things in particular on this slide, and that's something that we spoke about a lot. While we have 75% downside protection through 2022, we have upside exposure on 40% of our production, and that's because not all of our hedges are in the form of collars, which will of course have both a floor and a ceiling. So the upside exposure is more than the 25% you might expect when you get 75% hedging in place. Secondly, the 40% upside exposure is based on the preemption of the Cosmos Occidental transaction. And with the incremental barrels, the about 5,000 barrels a day that we now have added since completion a couple of weeks ago, that upside exposure increases to about 45% of underlying production. The chart on the right-hand side shows the theoretical realized oil price given any underlying market price. And as you can see from that, we have good downside protection whilst retaining meaningful upside exposure. This upside exposure was particularly illustrated at the start of the year in January and February, where we realized the price after hedging of $89 a barrel. And over that period, the market price averaged 96. So relatively close to the market price despite the material hedge program. And that brings us neatly to the next slide, 7, looking at cash flow. The strong oil price realization that I just mentioned in January and February this year delivered approximately $70 million of incremental operating cash flow just over those first 2 months. compared to the cash flow guidance we gave at the start of the year at $75 a barrel. So that's a really positive start in cash flow terms. Also in February, we secured the $75 million payment that was due to us from Total for the Uganda final investment decision that was taken early in the year. That amount was always included in our cash flow guidance for the year, but it's certainly very good that we have secured that now. There was one negative on the cash flow side, which was the adverse ruling in an arbitration related to legacy assets in Norway, which ended up with a payout of about $76 million. But with the positive start on the oil price realization and the close to $70 million improvement, that is almost fully offset, and that's why our cash flow guidance for the rest of the year remains about $100 million at $75 a barrel average oil price for the rest of the year. As you can see on the chart on the right, as oil prices increase, we do have exposure, and if oil prices were to average $95 for the rest of the year, which is not inconceivable at the moment, then our free cash flow guidance for the year increases to about $200 million. It is worth noting that, again, these numbers do not include the impact of preemption. We completed that last couple of weeks ago, paying $118 million. And at the current oil price, that almost gets fully repaid within a year. So therefore, where we are today, our cash flow guidance should actually remain broadly the same with and without preemption. And then, of course, over the next few years, as we said in our press statement, at completion over the next 5 years, these additional equities will actually give us an incremental $300 million of free cash flow. On to more operational matters, and starting with our commitment to health and safety, which is really a key priority for us, as it has to be in our industry. We had a very good performance in health and safety, which is of course also a big part of being able to deliver operational excellence, because it means our people are always available to run our assets. We had a big improvement in our performance compared to the previous years, and that is despite increased activity levels. There were only 2 recordable injuries in 2021 compared to 8 the year before, and we had no incidents for loss of primary containment. That is industry speak for any spills. We have a strong focus on personal and process safety across the organization, and we have visible leadership on the ground, and they have provided a foundation for a strong safety culture. We have safety improvement plans. We engage strongly with our contractors, active leadership interventions, and we have a very, very strong reporting cultures, all of which helps delivering this good performance. Through 2021, COVID-19 has remained a key focus with various mitigation measures in place, scenario planning, and a rollout of an effective vaccination program. We have been able to minimize the impact on our safe operations. And in Ghana, we have now 100% of our workforce fully vaccinated. We think that the sustainable development of oil and gas in Africa will contribute to a better social and economic future for our host countries. And for us, Tallow, this translates into supporting local content initiatives. So just a couple of examples. In Ghana, we have spent about $1.2 billion with local suppliers over the last 5 years. And another example is our partnership with the Youth Bridge Foundation. We have a STEM radio school, and that broadcasts STEM lessons to over 1,300 pupils in Ghana last year. I mentioned earlier we have a commitment to be net zero on Scope 1 and 2 emissions by 2030. We have a well-defined set of activities that will get us that, starting with compressor upgrades and capacity expansion at Jubilee, and some process modifications on the 10 FPSO. And these activities will eliminate routine flaring on both FPSOs by 2025. And that will reduce our greenhouse gas emissions by 40 to 45%. The investment required for those activities is included in our plan. We're also looking at options to reduce flaring at the Simba field in Gabon. In addition to those operational measures, we're working with a consultancy called Terra Global and with the Forestry Commission in Ghana to deliver a portfolio of projects that will generate credits to offset a minimum of 600,000 tons of CO2 equivalents. We're also focused on initiatives that support Ghana's REDD+ strategy and other natural resource management and rural development policies. We believe it is important to look at environmental stewardship more broadly, so our focus also includes how we manage water, waste, and biodiversity. We make significant socio-economic contributions in our host countries. For example, last year, about $445 million. And we are committed to building trust with our stakeholders and by the way we conduct ourselves in an ethical and transparent manner, and by operating within a robust corporate framework. In 2020, we embarked on a systematic operational transformation, and this has delivered very strong performance across safety, but also reliability and costs. So this slide, if we talk about reliability, we have achieved very high levels of uptime on both FPSOs in Ghana, and we've done that by addressing long-standing equipment defects, and we have sustained this by putting in place systems to monitor and mitigate equipment risk. We're also focused on improving routine maintenance, and there's an active program underway to further improve asset integrity. We're aiming to optimize performance every day across every element of production, from the reservoir all the way to the surface facilities. In doing that, we maximize the production potential from our fields. For example, increased water injection in Jubilee and increased gas processing capacity on the FPSO have helped us mitigate decline in production. And we have defined plans in place to increase gas processing capacity further, and we also plan to further increase water injection. All of this has been achieved by us taking a more direct control of day-to-day operations on the Jubilee and 10 FPSOs. And this then leads us directly to the O&M transformation at Jubilee. We have an ambition to be a top quartile operator, and with the support from our JV partners, we have taken the decision to take over all operations and maintenance activities from MODEC on the Jubilee field when the current O&M contract comes to scheduled end date this year. We've also recommenced drilling activities in April last year, and the 4 wells that we have delivered, 4 new wells and the workover, have helped us, as I said earlier, increase production in Jubilee, and these wells were delivered ahead of plan. Looking at the cost side of operations, between 2019 and 2021, we have achieved a reduction in gross operating costs across both FPSOs of more than $150 million. One of the drivers for that was the elimination of shuttle tanker operations for offtakes at Jubilee. This is a hangover that dates back to the turret incident we had a few years back. We have now successfully commissioned an oil offloading system, which means that tankers are no longer required. We have also optimized the utilization of construction vessels. We have improved logistics resources, and we've reduced the onshore overhead costs. When we move to self-operated Jubilee FPSO later this year, that will provide a further catalyst for reduction of OpEx. Drilling CapEx is a large part of our capital spend. It's over 70% of our planned spend for the next 4 years. So there's a big focus on reducing and optimizing drilling costs. We have looked at the fundamentals of well design, and we have reduced the complexity of our wells. We have reviewed our supply chain strategy. We have built strategic partnerships, and we have really focused on reducing rig downtime. And all of that has helped us to reduce the expected cost per well last year from $75 million in the previous drilling campaign to about $60 million pre-drill expectations. And with a strong focus on delivery and really looking at continuous improvement all the time, we've actually delivered an average well cost of about $52 million last year. So as you can imagine, that makes a huge difference in a long-term drilling program in terms of cost. So this drilling program in Ghana, which is really the core of our turnaround strategy, the early success of that plan validates our theory that we can deliver production growth and value through a well-crafted capital investment program. So we're now engaging with our partners in Ghana as we're considering whether we should bring a second rig into Ghana in early 2023. The next few slides look at our investment and development plans in Ghana and the non-operated portfolio. Starting in Ghana, where we have two very large fields, Jubilee has about 2 billion barrels of oil in place, and 10 has about 1.5. At Jubilee, we've produced only about 17% of that oil in place to date. And Trax, who are our independent reserves auditors, they estimate that we can recover up to 35% of the oil in place, which would be another 342 million barrels. And that's a year-end 21 2P reserves figure. But beyond that, we're already focused on delivering not just 2P, but also the 2C resources, which you can see on the chart here, would add another 245 million barrels. So we have some way to go yet on Jubilee to deliver its full potential. At 10, we have historically focused on the Nyenra and Ntom fields, which account for about half of the oil in place, so about 750 million barrels of that STOIIP shown here on the slide. And to date, we've produced about 100 million barrels from those two fields. Our reserves auditors estimate that we can deliver another 100 million barrels from those two fields. We're also focused on the other 750 million barrels in place, which come from the undeveloped parts of 10. And we think that we can deliver an incremental 260 odd million barrels from those undeveloped areas. And that's shown as the 2C resources on the far right of the chart. Now looking at Jubilee in a little bit more detail, the core developed area of the Jubilee field, which is the hatched area on the map on the right, has an estimated ultimate recovery of about 600 million barrels, of which we've produced about half to date. So as I said earlier, there are still significant volumes to be produced from the existing and also future infill wells in that core area. But outside of that core area, and this is the development area, Jubilee Northeast and Jubilee Southeast, they are relatively untapped parts of the field. We have produced some of the reserves already just from the overlap with the core area. But there is still an estimated gross recovery of over 170 million barrels from those two development areas. And to date, we have produced less than 10% of that. So over the next 4 years, we're allocating capital of about $700 million, that's net to Tallow, into the Jubilee field. This is, again, a number that's pre-preemption, and the preemption adds about $50 million over that period. And the 2022 work program is focused on investment in subsea infrastructure for the development areas in the southeast and northeast. And the major part of our future capital investment will be on drilling, as we will have the infrastructure in place. This investment program, we expect, will lead to very meaningful production growth. And we think that it will result in Jubilee producing over 100,000 barrels a day by 2025. So clearly, this is a key investment area for us. On 10, the currently developed fields of Nyenra and Ntom contain about half the oil in place. That's the 750 million barrels I mentioned earlier. Nyenra is a geologically somewhat challenging field with complex channelized reservoirs and relatively poor connectivity, as we have found out, which really results in a lower recovery factor. So for example, a typical Nyenra production well will deliver about 15 million barrels, whereas a typical Ntom production well would deliver about 24 million barrels. Both of these fields have seen production declines faster than we have expected, which led to the slight underperformance last year. But there are a substantial amount of reserves and resources still in place, and we have identified a number of infill opportunities to recover those. But over the past year, we have actually put a lot of efforts into improving our understanding of the broader 10 area and the significant remaining potential outside and around the two core developed areas so far. And we, together with our partners, have defined a number of projects that target the undeveloped reservoirs with about another 750 million barrels of oil in place. And these areas include the Tweniboa field in the northeast of the license and the Ntom far west area. In addition to that, there are also areas with prospective resources in the far western part of the license. that have been identified for appraisal. So while we have identified infill opportunities in 10, which are expected to sustain production, in order to grow production in 10, we will need to invest, and we will invest in those new projects. And we will start doing that in 2022, this year, by drilling 2 strategic wells in the Tom Far West area. We will then later in 2023 invest in subsea infrastructure, which will allow these new wells to be brought on stream from 2023. Before preemption, again, we anticipate capital allocation of about $550 million net to Tullow over the next 4 years. The preemption increases that by about $100 million to $650 million. Now moving from Ghana across to our non-operated asset portfolio, where we have a defined set of projects and a well-defined portfolio of prospective resources, which is really driven and underpinned by our focus on near-field exploration opportunities. We've had recent successes at Simba, where we delivered the Simba 3 well that is now adding to production, and a discovery in the Wamba prospect in Gabon, which really highlights the regeneration potential that we see in these assets. We plan to invest about $250 million in the next 4 years across the non-operated portfolio, which will be sufficient to retain production at the current level of about 17,000 barrels, and that's net to Tallow in aggregate. So in summary, across our producing asset base, we have a well-defined opportunity set, which will deliver value and tangible production growth. In the last section, I want to highlight some of the catalysts which have the potential to add material value for Tallow. The first one is associated gas from Jubilee and non-associated gas from the 10 fields in Ghana. In 2009, Tallow and our JV partners pledged to provide 200 BCF of free gas from the Jubilee field to the government of Ghana. That 200 BCF we expect to be exhausted later this year, and we estimate the overall value of that gas that we have delivered for free to Ghana to amount to about $2 billion. We think that gas from the Jubilee field currently fuels about 30% of thermal power generation in Ghana, and therefore continued offtake of that gas from the Jubilee field doesn't only support our oil production, but it also provides supply for power generation. And because it is wet gas, the associated products also allow the production of liquid petroleum gas, which Ghana can sell in the domestic market. We're currently in discussions with the government of Ghana to finalize a gas sales agreement for the delivery of another 500 BCF of natural gas to start after the foundation gas, the first 200 BCF has been delivered. In addition to Jubilee, 10 has a very material undeveloped gas potential, and we have upstream infrastructure and a gas pipeline in place. So this is a commercially advantaged resource, which could really help increase gas exports to up to 240 million scots a day from Jubilee and 10 combined. And that, of course, has the potential to drive significant industrial transformation in Ghana and deliver energy security at a time of high global gas prices. Another area with significant change in 2021 has been in Kenya, where our team, together with our joint venture partners, has reworked the development plan. The new plan targets more resources, delivers higher production and lower unit costs, and has restructured a commercially difficult project into an investable opportunities. We submitted a field development plan for approval in December, and we're now working closely with the government of Kenya to progress this. In parallel, we're also in active engagement with potential strategic partners on a farm down from our current very significant equity of 50% in Kenya. Our goal is ultimately to try and converge both these processes and deliver both a farm down and an approved field development plan, which would give us a clear line of sight for a final investment decision in Kenya. Tullow's exploration strategy has changed materially in recent years. We have a much reduced license footprint, and we have a very clear focus on our core area of West Africa, and we focus on near field and infrastructure-led exploration opportunities around our existing producing assets. In Gabon, we have a number of prospects which we believe will deliver near-term production. Again, the Simba expansion project that we accelerated into 2021 and completed last year was a very, very positive step. And production from Simba is expected on account of this new well to be about 40% higher year on year. So it's really a key producer for us. And in Côte d'Ivoire, we have a 90% interest in an offshore block called CI 524. And this is on the border to Ghana, offshore, right next to the 10 fields. So it's a geological area we understand very well. And having proximity to a producing field means that we can benefit from cost and operational synergies, even during the exploration phase. In Ghana, we also see further potential. We're refreshing our data sets and are increasing our understanding of the subsurface around the existing fields. And we really believe there is more value to unlock through near field and near infrastructure opportunities. Outside of that core area of focus in West Africa, we also have a substantial prospective resource base in the emerging basins of South America. And in Guyana, Repsol, the operator of the Kunuku license, will drill the BB Potaro exploration well. That targets a 200 million barrels approximately prospect in the Cretaceous light oil play of the Guyana-Suriname basin. So to wrap up, and in summary, 2021 was transformational for Tullow. We have refinanced our balance sheet, we have strong liquidity headroom, and we have no debt maturities until December 2024. We have delivered strong operational performance with improved uptime. We're delivering new wells faster and cheaper than planned. And we have embedded strong financial discipline, which has resulted in a material reduction of our cost base. The strategy going forward for us is both very clear and very simple. We will allocate about 90% of our capital investment over the next 4 years towards the existing asset base with the aim to increase production. And this is all investment that goes into areas with low project risk and low subsurface risk. And as I said at the very start, this we expect will increase group production on a compound annual growth rate basis of about 8% from 21 to 2025. And that is including the preempted equities in Ghana. In addition to increased production, we have a number of catalysts which could really drive incremental value, such as the monetization of our gas resources in Ghana, the delivery of a farm down and FID in Kenya, and a high impact exploration well in Guyana in the middle of this year. All of this will be underpinned by the relentless focus on cost discipline, and this will deliver material free cash flow. Again, we guided about $100 million this year at $75 a barrel, with very good exposure to higher oil prices, in particular with completion of the preemption. And again, I said it earlier, at current oil prices, we can see free cash flow increasing to approximately $200 million this year. And that would also help us deliver our deleveraging target of less than 1.5 times as early as next year. So with that relatively swift run through a number of slides, I will hand back to Alex to open the floor to questions.
That's great, Rob. Thank you very much. And thank you again for standing in at the last minute. We really appreciate you going through the results and updating us on performance. And as you say, it's been a great transformational year. We're now going to open the floor to Q&A. We've had a couple that have come in ahead of time. We've already had quite a few during the webinar itself. But just as a reminder, if you would like to ask a question, please type that in to the chat box at the bottom of your screen, and we'll try and cover as many questions as we can. I'm going to start off, Rob, in a question that's come in here about free cash flow. So getting right into the meat of the issue straight away, the 2020 free cash flow guidance is very much understated because the company is focusing on further investing to increase production. What is your free cash flow expectation in 2023 at $75 per barrel? I'm not sure if you can give guidance on that, but what would be the sort of normalized free cash flow in 2022 without the CapEx growth? So maybe if we could just start with that, please.
Sure. So I think if we look at 2022 cash flow, we have strong operating cash flow, and we guided about $750 million. And that is clearly the basis to fund the investment program. And we have a huge amount of flexibility in our investment program. And we have actually chosen to increase the investment in 2022 somewhat on the back of the rising oil price. So really the free cash flow is somewhat by choice. We could deliver more free cash flow this year if we invested less, but we're really focused on delivering value and increasing value. And that's for us particularly important as we look forward to a refinancing of our debt facilities that we will need to do in the next, let's say, 18 to 24 months. So while we could underinvest now to generate a lot of cash flow, we would then not be able to deliver production growth going forward. And we don't think that helps anyone in the long run, not us, not our debt investors when we look at the refinancing, and therefore also not our shareholders in terms of value growth. I think in 2023, we will again have to make a decision as we look at our budget for the year, how much we want to invest. We have given guidance over the next 4 years, but we never guide for just the year ahead as early as sort of March 2022 for next year. The first time we will provide specific guidance for 23 cash flow, which will depend to a large extent on our investment program, will be in January 2023, and that's how we've always done that.
Thank you, Rob. That's great. Quick question here on specifics about tax liability. Do you have a tax liability with the government of Ghana, and can you explain what this is and elaborate on potential outcomes?
So tax liabilities in Ghana could be interpreted in a number of ways. There is, of course, the ongoing income tax, corporation tax that we have to pay. So that is certainly a liability. But I suspect the question relates to the uncertain tax issues, tax matters that we've reported about. Really, there are two things running in Ghana in respect of tax. One is a demand by the Ghana Revenue Authority for a certain amount to be payable in respect of what is called branch profit remittance tax. Now, that is a tax that, according to the petroleum agreement, we don't believe we are subject to. And we have made that clear to the government, and we have handed over a decision on this particular matter to international arbitration. So we very strongly feel that there is nothing payable in that respect at all, and we'll have to wait for the outcome of that arbitration review. We don't think that will conclude this year, so it's more likely something for next year. But again, we feel very strongly that this simply does not apply to Tallow. The other matter that is currently live is in respect of tax allowances to reduce our tax liability, and specifically in respect of the financing costs that we have incurred to fund the development in Ghana. So there is disagreement on the amount that is allowed to be offset. And again, we believe that we have allocated the right amount and a justifiable amount of financing costs towards Ghana to reduce our tax bill, which we're absolutely in our right to do. And this is just a disagreement that we're currently discussing with the government of Ghana. Again, we don't expect that there will be a very material liability resulting from this. Okay,
thank you, Rob. You have to apologise. I'll apologise for my pronunciation of this, but has Tallow any interest in drilling Orindoik? It appears to this project is being sort of kicked down the road.
Yeah, so Orindoik, I think you said that very well. Orindoik is the second license offshore Guyana that we have an interest in. We are in fact the operator of that license, so it's next to the Kanuku license where Repsol is the operator, and it's the way to put it. We have drilled 2 wells in the Orindoik license in 2019 with mixed results, but they have certainly proved that there is oil. So they remain very interesting to us, but with a limited amount of capital that we're willing to invest in or allocate towards exploration. We have 1 high impact exploration well this year, which is in the block next door. We're looking forward to the result of that. We're very excited about it. And the outcome of that will certainly have an impact on the overall view of the basin and our 2 licenses, and that will therefore drive any potential investment in the future.
Okay, and a follow-on question to that. If you don't drill there, will you sell or divest that asset?
Yeah, so again, it's a bit early to say that. We have had some discoveries, again, with mixed results. I think we need to wait for the result of that BB Tullow well, as it's called, in the Canuka license this year, and that will feed into the wider view of the area. But clearly, with the discoveries that have been made a little bit further offshore by Exxon, which are very, very material, the whole area remains very, very attractive, and we just need to find the right way to extract the best value from that.
Okay. I think you commented on some of this during the presentation, but perhaps a little bit of clarification here. Have you benefited much from the recent rise in oil and gas prices, and how do you decide on your hedging policy? Okay, so yes, we have benefited. I happen to still have up the relevant slide here. I think I did say that we generated about $70 million of incremental cash flow in January and February versus our guidance. So absolutely, we have benefited, and we will continue to benefit, again, as the chart on the right-hand side here shows. We have a very material hedging program in place right now, courtesy of the refinancing this year. So if you cast your mind back to a year ago, we were in a somewhat precarious position, and the key focus for us really was to ensure that we can refinance our debt maturities. And in order to do that, we needed to provide very, very material downside protection. And at the time, Brent was hovering around the 60, maybe mid-$60 per barrel mark. So really not far away from, dropping down to the 50s or below again. And things were very unpredictable. So we took the decision that we help our investors by providing very material downside protection. And that's how we've got this program in place of 75% for the next couple of years, through to, now for 1 more year, through to May 23, and then 50% for another year. Before the refinancing, our hedging policy has always been protect 60% of downside for the current year and 30% of the downside for the following year ahead. And we would build that program on a rolling basis as we move from year to year. And it's really important for us to protect the downside, because we are exposed to a single commodity. And if long history hasn't told us anything, certainly very recent history tells us that oil prices can be and will be extremely volatile. And while, of course, we would love to benefit from all the upside at all times, it becomes extremely expensive if all you put in place are puts for downside protection. So that's why we have a mixed program, usually of collars and sometimes puts, depending on where the oil price is. So really, we try and protect as high a downside as we can, but we also don't want to spend more than $2 a barrel on hedges. So that all those factors together will drive what we do going forward. And maybe as a final comment, at the moment, we are rolling off the hedge program that we implemented last year. And as we approach the end of 2022, we, of course, look into 23 and note that from May onwards, we have downside protection of 50% currently, which is below the target that we would have had in the past. So at some point later this year, I will make a new hedge recommendation and bring that to our board, because that is a board reserved matter to determine the strategy. And we will just have to have a look whether, with the increased focus on producing assets, less uncertain expenditure, if I can call it that, in high impact wildcat exploration, we may choose to actually hedge a little bit less going forward, which would also increase our exposure to the upside. But again, that will be a decision for later in the year. For now, we're letting run off the existing hedges. Okay, thank you. A question here on about assets. Wondered if you could actually update us on the policy of selling down any assets further.
Yeah, so there is no specific policy on selling down assets further. We have been very clear on Uganda for a long time, which was completed now in 2020. We had 2 asset sales early 2021. One of the assets was a very, very mature asset with very high ongoing operating costs. The other one in Gabon was a very good asset, but one that required a high amount of capital investment over the next 2 to 3 years, and would therefore not generate a lot of cash flow. So again, we felt that these were very good candidates to monetize. And we're very happy with the asset portfolio we have right now. We have no immediate plans to sell any of our assets. The exception is, of course, Kenya, which we talked about, where we'll be looking to farm down from our 50% equity. But beyond that, no specific plans, no policy, other than to say, if anyone approaches us with a good offer, and it would have to be an offer for full value, because we're not desperate in any way, then we would have to consider it, and we would bring it to senior leadership and the board. But that would have to be someone coming to us with an attractive offer. Otherwise, we're not really in the market to sell assets at the moment.
Okay, thank you. Got a couple of questions here on sort of tax, and I'm going to try and group them together to ask to you. Could you sort of comment generally about the tax regime in the various countries, and are you wary at all of windfall taxes being applied to you?
Yeah, so starting with a very broad statement, which is we operate under contracts which are either petroleum agreements or production sharing contracts across all our producing assets. And all of these include what's called stabilization clauses. So what these stabilization clauses do, they effectively fix the tax regime that we signed up to when we entered the licenses and committed to capital investment and development activities. So therefore, windfall taxes, should really not apply to us. And if anything was imposed on us, then we would certainly strongly resist that and point to those stabilization clauses. So we do not expect any windfall taxes to be imposed on us. With the high oil price, through the production sharing contracts, and also with the income tax calculation in Ghana, the host countries do benefit already from the high oil price. So it's not as if they're completely losing out. The tax regimes in Ghana, it is very easy. We have a 5% flat royalty rate and then a 35% income tax. And in Gabon, it is a combination of, again, a similar income tax regime for some fields and a number of production sharing contracts where we effectively pay through an allocation of profit oil. So the state takes a certain percentage of the oil, and that is really tax in kind effectively. And if you look at our fact book, which is on our website, you can see the fields where we're subject to those production sharing contracts, and where effectively our net entitlement, as we always refer to, is a percentage of the physical production that we report. So that effectively pays for our taxes.
Okay. Got a few questions here on Kenya, so I'm going to try and sort of again group these together. So one is sort of the Kenya project has been near enough written off in the 2021 accounts. But if it does come back to fruition, what impairment reversal are we likely to see? And the sort of the linked sort of questions with that are, how are you planning to capitalize, monetize Kenya? And I guess, why has it just taken so long?
Okay, so a broad question covering Kenya there. So we have attempted to farm down our equity in Kenya. Again, we have 50%. Which is a very material stake in what is going to be a very material development. We tried that in 2019, and for various reasons that was brought to grinding halt. Certainly COVID wasn't particularly helpful, but what that did is it gave us an opportunity to have another very close look at the project and the development scheme, and that has resulted in a revised development plan. And that revised development plan has better economics, courtesy of more oil that we think we're going to produce at higher rates from the start. So improved economics, and while it is marginally more expensive in terms of development cost, it actually has a lower per barrel cost. So we've turned it into a very investable project, and we are now talking to potential strategic partners to farm down this much improved project. In terms of valuation and impact on financials, Clearly, I can't give any indication at all on valuation because that is commercially sensitive and would not help any external discussions that are ongoing. But just in terms of impact on the financials, in the near term, you should not expect any impact at all from a cash flow or EBITDA leverage perspective. And that's because we currently don't have any material expenditure in our plan. Expenditure will only arise once we reach final investment decision, which will kick off the major developments. But our ambition with that farm down is to get a carry for Tullow's share of the investment that's required through to first oil, which means it is effectively cash flow and therefore EBITDA and leverage neutral through to first oil. But of course, when we complete the farm down, and that will crystallize value, and that it puts a clear dollar valuation on the equity, and we believe that should and will have an impact on the equity side as well.
Okay, thank you. Again, got a couple of questions here on debt reduction, some link to that Kenya question previously, but if the leverage number comes to 1.5 times, perhaps sooner than expected, will that influence the dividend strategy? So perhaps you could comment on the dividend policy and how that links to your leverage ratios.
Sure. So the first observation I would make is that while at current oil prices we may reach lower leverage inside potentially of 1.5 times relatively quickly, I'm the group treasurer here, so I need to always put in a word of caution, which is leverage as a function of the denominator EBITDA and the numerator EBITDA and the denominator the net debt. And while EBITDA might go up with the higher oil price, net debt doesn't come down very, very materially, but as a ratio, it comes down quickly. So net debt, for me personally, is still going to be somewhat high. And also if the oil price drops and EBITDA reduces, then that ratio goes up again. So I think I'd like to see a truly sustainable reduction to less than 1.5 times. And at the moment, we don't have a dividend policy other than not to pay dividends. So really shareholder returns need to be driven by a share price accretion. We will look at tangible or explicit returns, whether that be in the form of dividends or buybacks, once we have reached a sustainable level of less than 1.5 times leverage. Okay,
thank you. I think when you were talking, you talked about negotiating with the Ghanaian government on sort of gas sales there. And the question here is, will the price of gas currently being negotiated be based on a realistic commercial rate given current worldwide prices?
So I don't know what the person that asked the question has in mind when they say realistic commercial oil prices. Again, I can't give any guidance on numbers here, but it's worth remembering that the gas that we deliver from Jubilee is associated gas, which means it is produced whether we want to or not as we produce our oil. So any value we get paid for it is upside and is incremental. What I can say is the Sankofa gas field, which is the other source for gas into Ghana, they have a price of about $8 per MMBTU. And we believe what we are discussing with the government of Ghana should be very attractive to them relative to the cost of Sankofa gas.
Okay, thank you. Linked to that, I think, in this question, so bear with me a little bit. What is the range in terms of gas prices? There is usually a material difference between non-associated and associated gas pricing. And should we not expect at least the same as for the ENI field next door? Does that make sense?
Yeah, I think it does. I'll certainly answer what I believe answers that question. So yes, there is absolutely a difference between associated gas and non-associated gas. And the difference is exactly what I said before, that on Jubilee, there is no capital investment associated with producing the gas because it comes out of the ground as we produce our oil. We do have some associated gas on TEN as well, But on TEN in particular, we also have some opportunities to develop non-associated gas from gas fields. And as I say the word develop, that means we have to invest funds to bring that gas to surface and export it to Ghana. So therefore, the gas price for that non-associated gas would need to be higher because it requires us to invest money. But again, I can't give any indication on numbers or ranges, but would point again to the Sankofa gas development, which is at a cost of $8 per MMBTU to the Ghanaian government.
Okay. Question here about your capex, or you've got the annual expenditure on exploration between 150 million and 450 million dollars. This seems like a very wide range. And how do you decide what you actually spend?
Yeah, so it's a very wide range because we are the operator in the two key fields where we have large equities, and even more now with the completion of the preemption. So that gives us a big amount of control over how much we commit to spend. Now, we say we have this flexibility, and that is true, but we have to bear in mind that we would only go to the lower end of that range if oil prices really crash again and we want to maintain liquidity and preserve our capital, because clearly that would take us down to the minimum maintenance capital required to just keep the oil fields running, but would not include any investment in future production and value creation. So we don't want to go there. All we're saying is we can if oil prices or the external environment forces us to that. And at the other end of the spectrum, we have a huge amount of investment opportunities, and we can always invest a little bit more. And ultimately, what drives the decision is the long-term expectation of value creation from the investment, and a look at our own, liquidity projections, because we set out at the refinancing to be cash flow neutral at around $55 a barrel. And as we came into 2021, we had taken the decision that we could actually, get my years wrong there, 2022, taking the decision that we could spend a little bit more. So we've actually increased some of our capital for this year, which would give us a break-even price of slightly higher towards $65 a barrel. And we'll take another look as we go into 2023 and decide how much capital we want to allocate, with one eye always on liquidity and the other eye on delivering production growth.
Okay, thank you. I think we've got time for one last question. I do apologize if we haven't been able to cover all questions today, but we had so many that have come in. But I'm going to ask one last question, and it goes back to Kenya, because we've had a couple of interesting points on this, which is Africa Oil recently announced the final investment decision date for the Kenya project to be the 10th of May. Is this a deadline for a strategic partner to be announced? And can you comment about how close you are in terms of securing a strategic partner?
Yeah, unfortunately, I can almost not comment at all here. We have clearly not given any indications of dates and deadlines. Africa Oil have chosen to do that. We have not. And really, until we have something to announce, we can't say anything at all in that respect, I'm afraid. So okay. I think my last answer may be the most unsatisfying of the Q&A so far. So apologies for that.
Well, Rob, you have done a very good job answering all those questions. And thank you again, as I said, for stepping in at the last minute. We really appreciate you doing that. And I think you have done an excellent job answering questions and doing so very comprehensively and also very clearly. So thank you for that. As I said, we come towards the end of today's webinar. Just want to mention a couple of points. As you'll exit today, you'll come to a short feedback survey. It'd be really appreciated if you could just spend a few moments completing that. And as you leave, you'll see on your screen some webinars that we've got coming up. A couple of weeks' time, we've got Lloyds Banking Group PLC on the 7th of April. And then later on in April, we have both Capita on the 27th and Check It PLC on the 28th. So thank you again for attending. Thank you, Rob, for presenting, and we would hope to see you all soon.
Thank you very much, everyone. And thank you, Alex, for running this so smoothly.
Thank you.
Thank you. Goodbye.